Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing medical properties trust stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a mid-cap company, 2.8 billion market cap. They're trading at $4.70 a share and they have 600 million shares outstanding. MPW is a real estate investment trust that invests in healthcare facilities subject to triple-N leases. They own over 400 properties in the US, Australia, Colombia, Germany, Italy, Portugal, Spain, Switzerland, Finland, and the UK. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Free cash flow looks pretty steady. It peaked in 2021 at 800 million. It is down to 500 million in 2023. But they had their highest margins in 2023. They converted 58% of their revenue into free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. That looked good until 2023 when they had a big negative. They passed through a big valuation allowance because one of their tenants is struggling to pay rent. Revenue is the rent and lease payments they receive from their tenants. And that peaked at 1.5 billion in 2021 and 2022, down 43% into 2023 at 870 million. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 4.4 billion. We discounted the numbers back to today using weighted average cost of capital. We get a value of the company of $4.2 billion. We divide that by 600 million shares. And we get a calculated stock price of $7. They're trading at $5, so they're trading at a 33% discount. It's a pretty strong buy according to the model. But if their financials keep going down, like their revenue and their free cash flow, even if the stock is undervalued, it will not come up because investors look towards the future. And if the future looks grim, then no one's going to buy the stock. There are 16 companies in the same industry as MPW, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend about $500 million in CapEx. These are investments in property, plant, and equipment. When they buy a new property, that's an investment in CapEx. They're a bit leveraged, 1.3 debt to equity ratio. For every dollar of equity, they have $1.30 of debt. They pay an extremely high dividend, over 20%, because their stock price came down so much, but they may cut their dividend. They're still generating positive free cash flow. Healthcare Realty Trust is the most at 880 million. They rank 7th in market cap. Welltower is the largest by far. They have really good price multiples. They're trading at 5.5 times free cash flow, 3 times revenue. And they're still generating a good amount of revenue relative to their market cap. But their 5-year annual revenue growth rate is coming down. It's only 2%. Healthcare Realty Trust is the most at 14%. So just this week, the stock soared 19%. The big jump came from Steward Healthcare. They struck a deal to divest its nationwide physician network to United Health. And the reason the stock jumped so much is because Steward is MPW's biggest tenant. Steward has been in financial hardship. They have not been paying their rent for several quarters now. And they mention it right here. Steward is 20% of MPW's total revenue. Let's take a look at their 10K. We'll start with the income statement. This is 2021, 2022, and 2023. Revenue of 870 million. That's down from 1.5 billion. Most of their revenue is from rent, 800 million. They also get income from financing leases and interest income. And it looks like they took a loss of 128 million. That's probably from Steward. And they also have expenses. Some of the properties have a mortgage on it, so they pay interest on those mortgages, 411 million. Then there's depreciation expense, 600 million, and then various other expenses related to the property, almost 200 million. So their expenses are higher than their revenue. But in 2021 and 2022, revenue was higher than expenses. So they had a net loss of 2023 of 556 million compared to a gain of 900 million last year. And their shares outstanding are flat from last year, but up from 2 years ago. Here's a breakdown of their revenue by location. Of the 871 million of revenue, that's rental income, 407 million is in the US. California is the biggest at 100 million. And they also have a lot of revenue in the UK, 352 million. The next biggest country is Germany, 38 million. Australia, 30 million. Let's take a look at the balance sheet. Total assets of 18 billion. That's down from 19.7 billion. Most of the assets are the physical locations they own. Liabilities of $11 billion. Most of the liabilities are debt, $10 billion. Assets minus liabilities equals equity, $7.6 billion of equity. They raised $8.6 billion from selling their business. They lost $1 billion from running their business. Let's look at the statement of cash flows. Even though they had a net loss in 2023, they still generated positive cash flow, positive $505 million. It is less than last year of $739 million, $811 million before that. They took a big write-down of $650 million. Most of that write-down is the expected rental loss from Stewart. In their investing section, they spent $235 million of acquisitions. Last year, $1.3 billion. Before that, $5.4 billion. And they received $900 million from the proceeds from the sale of real estate. In their financing section, they paid back $1 billion of debt. They added $570 million on a revolving facility. They paid out $615 million of dividends, which is lower than last year of $700 million. So they had a cash outflow of $1 billion in their financing section. Let's take a look at the stock on Simply Wall Street. Its last price, $472, $2.8 billion market cap, up 11% in the past week from the big news, down 39% in the past year. Let's see what they say about the company. Medical Properties Trust is a self-advised real estate investment trust formed in 2003 to acquire and develop net leased hospital facilities. From its inception in Birmingham, Alabama, the company has grown to become one of the world's largest owners of hospital real estate, with 441 facilities and 44,000 licensed beds. Their financing model facilitates acquisitions and recapitalizations and allows operators of hospitals to unlock the value of their real estate assets to fund facility improvements, technology upgrades, and other investments in operations. It looks like the stock started trading in 2005 around $10.50. About a year and a half after IPO, it was up 50% to about 16 bucks. Then in 2009, it dropped to a little over $3. But from 2009 to 2020, it looks like it did pretty well. It paid a nice dividend and went up. It peaked at $24 in February 2020. Then the COVID dropped to 13, but then it ran up like most stocks did in 2021, up to $24 in January 2022. But ever since then, it's only been downhill for this stock. It fell to $4 recently, but it had a nice run up. It's getting close to $5. Simply Wall Street has them valued at $9.52. They say the stock is 50% undervalued. 9 analysts priced this stock at $4.56. They say it's overvalued. The revenue forecast for 2024 is $1.2 billion, 2025 also $1.2 billion, and 2026 a bit under $1.2 billion. Their revenue back in 2013 was $218 million, and it had a nice steady climb over the next 9 years to $1.6 billion. That was in mid-2022. But it's been dropping a lot since then, especially the last couple of quarters with Stewart. Their revenue is down to $885 million. Here's their debt and equity since 2013. Very close. But now their debt is a little higher than their equity. Debt of $10 billion, equity of $7.6 billion. They always paid a nice dividend, 6% in 2014. It was down to 5% in 2021. But the stock has dropped a lot, so the yield has gone through the roof. It's 15% at the end of 2023. The forecast is 11% by 2026. The CEO's salary is $1 million since 2017. Total compensation $16 million. Tenure as CEO 21 years. 73% of the company is held by institutions, 24% by the general public, and 2% by insiders. The biggest shareholder is Vanguard at 14%, then BlackRock, State Street, Cohen & Steers. Lots of big companies and funds own the stock. You can see UBS, Eaton Vance, Citadel. Their employee count has gone up from 32 to 121. REITs don't really need a lot of employees. And the ticker trades on the New York Stock Exchange, Deutsche Börse, London Stock Exchange, Mexican Bolsa, Bulgaria, and Sao Paulo Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.